This episode is brought to you by Mortgage Workflow Partners and the Mastering Encompass series, both for users as well as administrators. You can find out all the information about it over at masteringencompass.com. Also, if you'd like to check out what we're doing on YouTube, go ahead and subscribe to the channel using the @MasteringEncompass handle. And make sure you stay up to date on all the information, not just with podcasts, but also video content that we bring to you as often as possible. Now let's get on to the episode. Hi everyone, Larry Bailey here, Mortgage Workflow Partners, bringing you another weekly market news update. This is for the week of June 16th, 2025 in review. We've got some big news here. We've got the Feds holding the rate steady, home construction slows. These are all the updates from last week to make sure you know what's going on. We saw, due to continuing economic uncertainty, the Federal Reserve decided to keep its benchmark Fed funds rate unchanged. The environment's also contributed to a slowdown in both the construction and retail sectors. Additionally, unemployment claims are trending higher. Let's talk about the stories we're going to go over today. First story is Feds remain cautious, holding rates steady. The next story is home builder confidence further falls in June. We see housing starts and permits reach its lowest level since 2025. As stories followed closely by the retail sales reporting sluggish in May. We see unemployment claims indicate cracks in the labor market. We've got a family hack of the week, and then we'll talk about what's going to happen in this week. Of course, we saw a lot of things change over the weekend with the United States bombing Iran. We see that as the markets continue to change, who knows what's going to happen. That's why you need to know what's going on. On that regard, if you have any use of Encompass as your loan origination software, make sure you head over to masteringencompass.com to check out all the information. It's free to join. And most importantly, if you want to watch this as we go through on video instead of just listening at the podcast, in case you're doing that, make sure you head over to masteringencompass.com. So let's get over into the stories here. We see the first story is the Fed's remaining cautious and holding rates steady. Federal Reserve unanimously voted to hold its benchmark Fed funds rate steady at 4.25% to 4.5%. This continues the pause that began in January of this year. This decision was widely anticipated by analysts and also reflects the Fed's ongoing concerns about balancing risks related to both inflation and unemployment. It's important to remember that the Federal Reserve has two mandates to balance the maintaining price stability as well as promoting maximum employment. It's also important to know that achieving both goals simultaneously can be challenging, especially as the new tariffs add to the economic uncertainty. Typically, persistent inflation discourages rate cuts, while signs of economic slowdown would prompt the Fed to consider lowering rates. It's also important to remember that the Fed funds rate affects overnight lending rate between banks. It influences broader interest rates throughout the economy, although does not directly set mortgage or long-term rates. Looking forward, we want to note that the Fed will closely be watching the upcoming reports on inflation and employment, as its future policy decisions may depend on which risks become more pressing. Notably, the Fed's most recent projections for 2025 indicate that the core PCE, that's the personal consumption expenditures, is now expected to reach 3.1%, which is higher than the original estimate of 2.8% it made last. This unemployment rate we're also dealing with is also projected to edge up slightly to 4.5% from 4.4% estimated in March. Despite these uncertainties, the Fed officials still anticipate 2 interest rate cuts later this year. We shall see. See what happens. This next story, home builder confidence falls further in June. You see a nice image on here, gives you a chart of what's been going on since January, and we see a downward trend. The home builder confidence continued to decrease in June, according to the latest data from the National Association of Home Builders, that's the NAHB. Their housing market index fell from 34 in May to 32 in June, marking the third lowest level since 2012, and remaining well below the important 50-point mark distinguishing between expansion from contraction. All key components of the index declined further into contraction. Buyer traffic slipped by 2 points to 21. Current sales also declined by 2 points to 35, and sales expectations for the next 6 months dropped 2 points to 40. So the bottom line here is the NAHB links this ongoing decline in builder confidence to persistent high interest rates, continuing tariffs, and overall economic uncertainty. This all leads to more potential buyers delaying their purchase transactions. Chief economist for the NAHB, his name is Robert Dietz, stated that these factors have led the association to project a decrease in single-family housing starts for this year, 2025. And what do you know? That brings us right to the next story. The housing starts and permits reached the lowest level of 2025. And we see some good information here. And so after we saw a brief rebound in April, housing starts fell sharply by nearly 10% in May, primarily due to significant decrease in multifamily projects. Single-family home construction remained relatively stable with a modest 0.4% increase from the previous month. Building permits also declined by 2% overall, and single-family permits fell by 2.7%. The annualized rates for both housing starts, which is 1.26 million, and permits at 1.39 million, are at their lowest level so far this year. These figures represent the projected number of housing units if builders continue at the current pace for the next 12 months. So it's important to note that although the building permits generally provide an early view of housing supply in the future, it's also important to note that many projects with approved permits may not even move forward because of their high costs of construction driven by tariffs. Housing starts offer a more reliable indication of future housing inventory since the construction is already underway. And unless there's financial trouble, builders typically finish what they start when it comes to housing because that's how they get their money back. May's seasonally adjusted annual rate of 1.26 million starts is still well below the average of 1.8 million new households formed annually over the past 5 years. It's important to note that even with annual completions at 1.53 million units, the supply of new homes continues to fall short of demand. This ongoing shortage is likely to support home values in the coming months. Next story. Retail sales sluggish in May. Retail sales declined by 0.9% in May compared to April, which was steeper than the anticipated 0.7% decrease. This marks the second consecutive monthly drop, following a strong 1.5% gain in March, when consumers accelerated purchases ahead of their expected tariff changes. Out of the 13 categories tracked in the report, 7 experienced declines, with autos, building materials, and gasoline showing the largest decreases. It's important to note on the positive side, the control group, that excludes autos and gasoline and building materials and food services, that rose by 0.4%, surpassing the expectations set. This measure is especially significant because it directly contributes to the second quarter GDP calculations. So it's important to note that while retail sales are a key measure of consumer spending and play a critical role in assessing the overall health of the economy, although May's results were below expectations, this decline may simply reflect a normalization after the earlier surge in purchases after the tariffs were announced, but before they went into effect, right? Fed's officials are expected to monitor future retail sales data closely, as trends in consumer spending will also influence their decisions, the Fed's, on interest rates and monetary policy. All right, let's get into the next story of unemployment claims indicate cracks in the labor market. Initial weekly jobless claims fell by 5,000 to 245,000, but this figure remains among the highest levels since October, with continuing claims also dropping slightly by 6,000, bringing the total at 1.945 million still receiving benefits. Now, for over a year, continuing claims have stayed above 1.8 million and have now seen settled in above 1.9 million for the last 4 weeks in a row. We'll see what happens here, but the bottom line on this story is the upward trend in both initial and continuing unemployment claims underscores persistent challenges within the labor market. Furthermore, since unemployment benefits usually last about 26 weeks, the increase in continuing claims as benefits expire also suggests deeper weakness in the job market and indicates that the hiring is proceeding at a slower pace overall. Hey, did you know what June 27th is? You guessed it, it's International Pineapple Day. And if you're looking for a recipe, check it out on screen here. If you're listening to me on podcast, head over to masterencompass.com. In this spot in the video, you'll see the cool recipe. It's a refreshing summer dessert. It's a honey glazed grilled pineapple recipe from the Food Network. Check it out. It's got my mouth watering actually, and let us know how it goes if you decide to make it. Here's what we're looking at for this week, gang. Home price appreciation data will be released Tuesday, while May's existing home sales and new home sales and pending sales are scheduled for Monday, Wednesday, and Thursday, respectively. Thursday will also see the release of weekly jobless claims and the revised first quarter GDP numbers, a key figure that investors are monitoring closely, especially after earlier estimates showed a 0.2% economic contraction. To close out the week, Friday brings the release of May's personal consumption expenditure, that's the PCE, and as we said earlier, that is the index that is the Fed's preferred measure and gauge of inflation. We'll see what happens. That's it for now. Thanks very much. My name is Larry Bailey. Appreciate you listening along. We'll see you on next week's update. Catch you then.